For the past 12 to 18 months, the Indian IT sector has felt like a dead weight in the portfolio. The Nifty IT index is stuck in a painful sideways churn, and the big question everyone is asking is this a temporary correction, or is the rise of AI finally going to make Indian IT redundant? Today, we're going beyond the noise. We're going to break down the two main reasons for the pain and reveal why the biggest threat to IT is actually its largest multi-year opportunity. If you're invested in TCS, Infosys, or Wipro, you need to hear this complete analysis. First, let's talk about the pain. What's actually hitting your IT stocks? It's a combination of external headwinds and something called a time correction. Simply put, the core clients of Indian IT, major corporations in the US and Europe, are tightening their belts. High inflation and high interest rates mean they're cutting down on discretionary IT spending. This means slower growth guidance, margin pressure, and FPIS selling out, all creating a cautious environment. The time correction. Unlike a sharp crash, this is when the stock price stays flat or moves sideways for a long time. While the company's earnings, continue to grow, the stock price is stagnant. This allows the high post-COVID valuations to normalize. The market is just taking a time out. Speaking of finding value, this is exactly the type of counterintuitive insight you need to catch big winners. We spotted a similar opportunity in the healthcare space, sharing a deep dive analysis on Yatharth Hospital with our community, an analysis that ultimately helped generate a 90% profit in just 9 months. If you're interested in receiving that same level of in-depth, original research, you can join my free weekly newsletter. The link to subscribe is right down in the description. It's a great way to stay ahead of the curve at absolutely no cost. Now let's get back to the good news. The next massive growth cycle for Indian IT is the very thing everyone fears: artificial intelligence. This isn't just a threat, it's a non-negotiable, multi-year infrastructure overhaul. Why India wins? Indian IT firms are the world's system integrators. They have the massive scale, the massive talent pool, and the decades-long trust of every major global corporation. When a CEO says, "We need AI integrated into every part of our supply chain," they don't hire a startup, they hire TCS, Infosys, and HCL. This is scale game, and India owns it. So as an investor, how do you capitalize on this time correction? Here are 3 actionable steps. Action 1, buy value, not momentum. Focus on quality names whose PE ratios have normalized to their long-term averages. You are essentially buying a future growth story at a discounted valuation today. Action 2, use the power of SIP. The time correction makes it impossible to time the bottom. A systematic investment plan, SIP, is the most disciplined way to average your purchase cost and build a position that will compound strongly when the global spending cycle inevitably turns up. The Indian IT sector is in a holding pattern, not a death spiral. It's shedding high valuations to prepare for the massive new revenue cycle driven by AI. Patience in this period of consolidation will be heavily rewarded. What do you think? Is it the biggest opportunity of 2024 and 2025? Let me know which IT stock you're buying in the comments. If you found this useful, hit that like button and subscribe for more insights. I'll see you in the next video.